Welcome to Loaded and Rolling. I'm your host, Thomas Wasson, and today we're going to be talking about mergers and acquisitions. It's been one of the big topics over the past few years. There's been folks going on buying sprees, those selling, and it's one of those big things that as we are looking at what comes next in this freight market environment, it can be anyone's guess, but I wanted to bring on some folks who are a lot more familiar with the M&A space because I think that's going to be one of the things to watch as we move throughout the entire year is going to be, kind of like as you're watching in National Geographic, who's the sickly gazelle and who's going to get eaten by much larger and more successful organisms. But in the freight space, that's normally things like large trucking companies buying up smaller ones or expanding into LTL or expanding into mixed modal. And so there's a whole lot of stuff to talk about. And so let's welcome on the folks at Tenney Group, specifically Spencer Tenney is the president and CEO of Tenney Group. And Spencer, absolute pleasure to get to talk to you. We've had the pleasure of having y'all on in the past, and super excited to be catching up.
Likewise, Thomas. One of the more interesting seasons of M&A in a long time. So I'm looking forward to having a conversation and sharing what we're seeing out in the marketplace.
So let's talk about M&A in general first. We're going to zoom out for folks who are trying to digest it. When you're looking at, trucking and freight is cyclical. It goes up, it goes down. I wonder, is M&A kind of a cyclical thing? Is there, when you mention in seasons, when is it that we start to see the activity? And is it like a tide or is it just more opportunistic?
Well, it really just depends on the buyer type. What I would say is that probably 85% of the total transaction volume globally is conducted where the buyer has some sort of existing synergistic capability available through a deal, or some investment in the same or related category, and so in doing so, which kind of takes away that cyclicality because in many cases there's always a reason to try to advance your current position. So we're always seeing consistent activity through strategic buyers. What is cyclical is more of your financial or agnostic private equity buyer who is, almost entirely reliant on what's happening in the capital markets, and that affects how they view a potential return on investment. And so, and so that just for the seller standpoint, really what it does, it just affects the available buyer pool and the characteristics of the buyers, depending on what's going on in the economy, what's going on in the freight market, and specifically, as we've seen over the last 24 months, cost of capital, and that's really what we're looking at. So there's always it's always good theater, no matter what. And then the other side of it is, though there's always transactions going on, the characteristics of the deals themselves, both the size and the strategic rationale change based on what's going on in the freight markets. And so I think that's where we see shifts in the marketplace, shifts in the profiles that are being targeted, and primarily the size of the transactions, which has really been interesting based on some of these announcements that we're starting to see some encouraging signs.
Well, let's dive into one of these announcements and then we can dive into the types of who's buying what. One of the big ones was the folks at WiseTech, a very large company, and made a deal to get E2Open. Tell us a little bit about that because that's one of the big players in the tech space. I interviewed them for some sponsored content back in the day. I didn't know they're that large. And so it's really impressive in the context of this deal. Give us some of your thoughts on that because that looks to be one of the big large ones for this year.
Yeah, what I see here, there's a couple of different things. One, I mean, the first thing that jumps out, as you mentioned, was just the size of the transaction. I mean, this is what reported to be a $2.1 billion transaction, which that gets people's attention, which for a lot of folks in freight tech, based on cautionary tales over the last 36 months, there's definitely been some trepidation for large capital investment in this space. And but what you see is, as you kind of peel this back a little bit, a highly disciplined, highly synergistic type of approach to getting a deal done that meets some of the challenges that's going on in the marketplace. And so to me, it's always exciting when these large transformational deals get done because it gives license for other folks to kind of emulate that perhaps on a smaller scale. But the principles that are taking place in this transaction are really interesting. Number one, what you see in WiseTech's acquisition of E2Open is that they're, overnight enhancing their overall end-to-end capabilities, which affects their value proposition, of which they can probably get immediate synergistic value from this deal, from existing and future customers. And so I think that's really, really exciting. It gives them some differentiating points that reduces cost of customer acquisition as they differentiate in the marketplace, potentially. But the other side of this is to go to the other side of the table. What I found was really interesting in the write-ups about E2Open's approach with this is that they also were demonstrating some significant discipline. They ran a process. Their board went out and examined multiple different strategic options to advance their current position, and ultimately arrived on the deal with WiseTech because it was the best. And so I think that back to that concept of disciplined M&A, I think that functions really well when you have both parties or all parties around the table kind of taking that approach. And in doing so, I think there's a high probability that this is going to be a overwhelming success on the other side of this transaction. And the takeaways for other folks are just think about that. How do you make a successful transaction? Well, you look for ways to create synergies that you can activate very quickly post transaction. And then from the seller side, you want to make sure what are your options, because not every buyer values your business the same way. They have different things that they can accomplish it. So what appears is true in this situation is that E2Open went, I don't know how many, but in a traditional process, certainly 5 to 7 different options. And some of those aren't acquisitions. Some of those could have been a variety, non-M&A type, to be clear. But what you can gather from the reporting is that they did their homework. They were very well prepared. And when they had those options in front of them, it allowed them to make a very level and very strategic decision that probably is going to dramatically advance the interest of all the shareholders. So to me, it's a fascinating deal, and I hope that it is a signal of things to come, both in large transformational deals, but other folks who are trying to accomplish similar goals on a smaller scale.
And I'm curious about the types of buyers. You mentioned private equity. The WiseTech folks, they're making a deal, they're making it outright. Is it normally like a very clear delineation? Is it like, well, private equity wants this thing, a company is gonna approach it from this area if they have extra cash flow or a credit line? Or is it kind of blended where, let's say I'm Thomas Trucking and I've got like 2,000 assets and I want to buy this 500 asset carrier, but I'm a trucking company. I don't just have like a bunch of cash. Do I have to, like, for M&A, I want to gobble them up? Do I have to get help from private equity, or is it like a pure? I always wondered how that worked in terms of like businesses buying it versus what kind of the strategy if you see like a PE firm just gobbling it up.
Well, I would say we've tried to track this like the last 5 years in our annual M&A report, like just the characteristics of offers of all buyer types. And what we see is that in over 85% of the deals, the buyer that ultimately makes an offer has some type of existing stake in the T&L space. And that's important to recognize, just because private equity, those that are agnostic are very much kind of anti-asset. If they don't have like a pre-existing type investment or experience in the asset heavy component of transportation logistics, it's very unlikely that they're going to have interest or see that investment as a competitive return on investment compared to other things that they might invest in. Things like freight technology or freight brokers, things that are asset light that have high capacity to scale with low additional capex. Those are the types of things where you have agnostic private equity groups coming in and making those purchases. Things, because it just makes sense from a financial standpoint. But without heavy experience, without just an understanding of how to get a return on investment in this space, I think it's probably a good thing. People are pretty humble. They're a little reluctant to just say, "Hey, let's try out trucking." So I think that where you see is kind of like usual suspects coming in and investing. But even for those that are not private equity backed entities, it's not that hard at all. Like for other folks that are either large, regional, or national players to go put together deals without outside capital, because you can borrow on the assets that you're acquiring. You have lines of credit that you can use. You can use seller financing. You can swap stock. You can do a variety of different things to structure deals and get things done. And I think, I think part of that's just getting in the game and learning as you go.
And you all have a really cool experience, been in the game for quite a few decades in the M&A space. specifically in the supply chain. What's kind of the thing that when we're looking at if someone gets bought out, like I was at US Express, they got bought out by Knight Swift. It looked to me like equity arbitrage where you had like $15 a share at their IPO. They're down to like three. Surely, if I buy this thing up, maybe I can get like $7 a share worth of it. What kind of goes on in the space when you're thinking of like, being in it? What were we looking at? What makes me an attractable candidate to be bought, or when should I think? When should I get to the point where it's like maybe I should sell?
Yeah. Well, it's going to be different based on what are the characteristics of your company. Like for instance, if you are a company that's 10 to 20 million in EBITDA and up, it's possible that you might be viewed as a platform type investment for private equity, and then of which they would build around via acquisition. Now, if perhaps you're smaller than that, it doesn't mean that you can't be purchased. It just means that you'll probably be viewed more as a strategic add-on or bolt-on to an existing operation. And the strategic rationale for the buyer in that situation will be to, hey, we want to upgrade talent. Perhaps they have access to customers, like the target company has access to customers that the acquiring company does not have and can't get, so that there's some value there. It could be for lane density. It could be for a host of different things. Ultimately, there's usually some element of redundancy that becomes appealing as far as eliminating duplicate expenses as part of offsetting the rising cost of operations. And so some of this is what we talk about. It's not like you don't have to overthink it. It's like, how are we going to reduce costs? It's like, well, we need to get more volume to increase purchasing power. We need to, get more efficient in terms of headcount per revenue. And then, that's where you'll see acquirers that, very, you know, without making a big splash, will gobble up 3, 4, 5 different deals because, you have great institutional knowledge with the founder who, is not fighting a fair fight anymore based on what the challenges in the industry. Maybe they have 100 trucks or something, but it's a lot easier to navigate what's going on in the space when you have 500 trucks versus 100 trucks, but it doesn't take away that person might have 30 to 40 years of experience that would be extremely valuable in another organization that could be spread across all kinds of different business units. And so that's where, we just see a lot of collaboration. And I'm seeing a lot more of that right now. And so I think that's why I'm really excited. There's a lot of folks, buyers and sellers, leaning in, trying to figure out how best to solve some of the most challenging problems we've seen in the T&L space in a long time.
One of the ones I'm thinking of is like RXO and Coyote. Both have a version of their tech platform, but Coyote had different customer base than RXO. And then when they made the purchase, it looked like it's almost like you're filling a gap in your puzzle piece.
Yeah, 100%. And I think that there's, um, and I don't know. I mean, sometimes tech will be a driving force on some of the, and certainly it's on the asset light side, freight brokerage. I think tech can play a major role as a value driver, strategic rationale for the deal. But what you're really seeing is a lot of folks of rather buy versus build. Like if we know there's a gap right now. Do we think that we can home grow the solution for that versus to go acquire something that's already a proven process? And I think history has demonstrated, both in T&L and other industries, that if you have the opportunity to go buy versus build, almost always the economics around that return are much more favorable to the buy solution versus the build solution. It's much more high risk if you don't already have significant experience in kind of building out those platforms or capabilities. It just makes much simpler, much faster. The impact is immediate. So that's why you see people taking that approach.
And I wanted to touch base on cost of capital. You brought up a great point. It reminds me of when I dipped my toes in the startup, and it was explained to me that like we are a lotto ticket in terms of a Series A sometimes or a pre-seed. So these large firms these funds are gonna start investing, and they're gonna expect a return, but also the cost of capital as an interest rates, which it's like if the Fed funds rate is at this, I could park my money and get like treasuries or something instead of trying to invest in all you crazy companies. Is that one of the things? Is it purely like an interest rate thing for cost of capital? Or when we're thinking of the M&A space and what cost of capital means, tell me a little bit more about that, because I think that's a fascinating, like bigger layer thing that kind of permeates down all these little decisions.
It is. I mean, I think when it comes down to it, sometimes when you think about, it's easy to think about it from like a real estate standpoint, right? Like if it's, um, why would I sell my house right now if I can only go buy something that's twice the interest rate that I'm paying right now, right? And so so I think for some folks that are looking to exit, what our encouragement is, like, especially for the asset intensive, like, okay, what are you paying to go put depreciating assets on the road? What is the cost of that? And then what's the opportunity cost of not redeploying that same capital, perhaps in an investment outside of T&L that doesn't have nuclear verdicts, that will probably provide a better return over time. And so that's some of the ways that we think about it. But from the other thing, that the most direct way is just from a business valuation side. If the cost of capital goes up twice as much, there's no way for, even if a buyer wants to do it, if they're going to have to go to an investment committee and sell it, there's no way that they can pay the same amount of money for a business if, one day the cost of capital is this and the next day it doubles. So there's always going to be an adjustment in terms of the valuation, or at least the deal structure, based on what the cost of capital is.
I wonder if that makes it harder for trucking companies themselves and the truckload to buy it out. Because I'm thinking, what if I have 1,000 trucks and I want to buy out this 200 truck carrier, but the cost of capital, how much would it cost for these trucks? Are they being like correctly, am I evaluating them right? Like, what if they're really old or the trailers? That's got to be really tricky compared to like your freight tech, your freight brokerage, or asset light, where you're really just buying like an office lease, some equipment, and some talent versus all this equipment you got to think about.
Well, I think part of it is just dictated by how much capital somebody's going to give you. I mean, I think that's part of it. But really, it's. I would probably take the inverse of what you said. I think it's much easier to say, hey, if you go get a third party appraisal on the value of the equipment, go shop who can give you money and at what rate. You may not like it, but that's pretty definitive. I think on the asset light side, I mean, it's much more subjective on what the value of that is based on who's valuing it. And you might be able to, especially on like tech stuff, you're talking about changing over to a multiple of revenue. There's a host of different things that, I mean, it's, there's definitely science. There's definitely some roadmaps to reference on how to come to the value, but largely it's what's a willing buyer and a willing seller able to agree on, and that's the value. I mean, like there's,
Yeah.
It's so. I think that's more subjective and a little bit, in some cases, riskier. But it really, how deals get done is just it's all kind of baked into, once I integrate this with my existing company, like what synergies can it produce, and how's that going to allow me to hedge from a valuation standpoint based on how I've purchased the business, and how is that going to help me accelerate getting the return. And when buyers do that, I mean, they the folks that are doing the deals in our space, they're highly sophisticated. They know what they're doing, and so it's very hard to get something down the line that hasn't, when you have to have a certain amount of people sign off on it, that they haven't scrutinized this to the hilt and feel comfortable that they're going to get something done. Doesn't mean that it's going to work out correctly. It just means that there's been a lot of thought around the table, especially if there's a third party debt provider or capital provider. If you can pass those hoops, that means that you've done a pretty good job of telling a story.
And being at the Tenney Group, having that experience, helping making deals and stuff, tell us a little bit. What's the most common way that takes place? Because I'm kind of curious. Where I don't do most companies just have the money up front. Like, let's say I'm the CEO, I was like, I want to buy this company, or do I kind of work with my board and say, I'd like to get a few extra $1 million. I need some help to get some outside funding. Let's put together. What does it look like for like a casual observer? Because a lot of times we just kind of see the end of it, which is like, here's the transaction, here's what you're getting. Like, what's kind of behind the scenes that you can share? Like, is it like matchmaking where I call y'all up and you're like, hey, I know a guy who knows a guy, I'm gonna help you out?
No, well, it just depends. Like, for instance, we're completing a deal here in the next week or two, and it's a large 9-figure type transaction. And but it's through a private equity group that had a dedicated, very large $300 or $400 million fund. And so, like, they've already, the private equity group has already, in advance of even shopping a deal, they've secured the capital. So it's a very simple, stroking of a check to get that handled. And so that's one way. For publicly traded companies who are, they make up a significant amount of the other kind of buyer pool. Some it's just cash on hand. They're just larger companies, and they're doing a lot of smaller type roll up stuff. Um, if they're going to have to do, if they're going to be doing a large transformational, billion-dollar type transaction, they're going to go out and have to raise capital via investment bank to go make that happen. But the majority, and I would say 80% of the deals that are kind of below that 50 million, top line revenue threshold, most of which never get reported. Most of those are done with existing tools on hand, which is asset-based lending. Just a third party go to use asset-based lender along with a line of credit with some seller financing, maybe some mezz financing. But there's kind of 4 or 5 different tools in the tool belt that almost any acquirer of any size can leverage to go grow via acquisition.
I'm curious about your thoughts. I've also reported on the autonomous space and SPACs, special purpose acquisition companies. And Kodiak is a recent one going SPAC. Plus is going SPAC. We saw a lot of SPAC activity. Is that kind of in terms of the M&A space? Is that like a acquisition? I'm just acquiring you with my publicly set up company that's meant to gobble them up and churn it in? Or what's your thought on that? Because I'm thinking almost, I've heard of a few SPAC deals. I haven't heard as many of those big blockbuster M&A ones yet.
Yeah, I mean, it's another tool in the tool belt to raise capital and get a deal done. That's the way that I would frame it. And just depending on what is the buyer's purpose and how they're thinking about it, I think that just kind of dictates when they pull that lever and use that instrument.
Yeah, and looking ahead, I wanted to get your thoughts on this year because you're giving me a master class on how the system works, which is really helpful for me. It's I wish we have these high level discussions on M&A and activity. It's really hard to find someone be like, so how does this stuff like go down? We're in like a back room or something. But looking ahead for this year, we've got Wise Tech making a deal, a lot of macroeconomic weird jitters and stuff. The Fed, people would love to have a rate cut, so cost of capital is kind of in an interesting spot. What are you looking at for folks who want to try to read between the lines? What are some of the big things you're just kind of keeping an eye on as we're coming up, second half of 25?
Yeah, I think that for the most part, the major points of sensitivity right now are, tariff exposure, disruption around that. And, what we're finding is that if you don't have exposure to that, I mean, it's a pretty aggressive market out there. For the deals that we have in play that don't have that exposure, we have a handful that are about to close or about to go under LOI. And so to me, it's very appealing when there's some level of insulation from some of the macro risk. For those that do have some exposure, what we're still seeing is folks leaning in. Because if you have a great company that I think some buyers are leaning in because perhaps there's an opportunity here and maybe a smaller buyer pool that's engaged. And so maybe there's a way for us to kind of get in and creatively get a great company while there is a little disruption by sharing some risk. And so, I have an all-star buyer panel that had some great comments as part of our M&A mid-year report that we're going to release in a couple of weeks. But it's just around structure. I think that's what we're seeing right now is more than happy to pay a compelling valuation on businesses. It's just a matter of risk sharing through, some of this uncertainty so that both buyer and seller can take care of themselves. And so I don't think sellers are not interested in engaging in any activity where they feel that the market is disproportionately punitive or buyers are being punitive in the way that they're receiving offers. There's no appetite for that. But I think what we're seeing is there's a lot of educated buyers that have a great background in terms of integrating effective deals. And they're just providing some creative paths for great companies to off-ramp rather than continue to fight some of these growing challenges by themselves. And it's not a fit for everybody. But I think what we're seeing right now and continuing to see is that, there's always uncertainty. It just changes. The name changes every day, what we're talking about, right? So there's always going to be some level of uncertainty. And I think what we're seeing is some level of fatigue that we haven't seen even over the last 36, 42 months where buyers are, maybe they don't want to get out, but they don't want to continue doing what they're doing exactly how they're doing it. If they have the ability to lock arms with someone that gives them a different path forward, maybe to take some chips off off the table in the process, that's a pretty compelling scenario for a lot of folks who, maybe they spent 20, 30 years in this industry or more, but still have most of their financial net worth tied up in an asset that's illiquid. And so I think that we're going to continue to see folks that are going to want to collaborate around unlocking that liquidity moving forward. And I think what I'm seeing from a lot of business owners who have great companies, it's about, hey, they see opportunity in this space. If this is going to be one of the most fun and exciting and exhilarating periods in T&L ever, I want to be a part of it. I just don't want to hold the same level of risk that I've held the last 5 years. I want to get some of my money off the table, and I want to be out of the weeds and putting out fires every day. I want to elevate my own strategic contribution to whatever organization that I'm working with. And I think that's what we're going to see is a lot of folks, buyers and sellers, working together to get founders of companies in that position, because I think it's going to be a lot of fun to see what they can do.
And final thoughts here as well, because I'm thinking about the nature of, you talked about T&L. If we're looking at who's going to be the most likely, if we're thinking of where's the smoke, that's eventually going to be the M&A fire. Is it going to be these freight tech companies, logistics providers? You mentioned tariff exposure, trucking. What are kind of these areas that we're seeing these green shoots where they're willing to make these deals, or we're looking for sellers who are like, yeah, I'd love to get to that next level. I'm in a good spot. Let's try to make a deal. What do you kind of see as, I guess, by vertical, or is there any kind of granularity you can give us in terms of like, I'd look at this way, not this way in the next 6 months?
Well, I think you're going to continue to see a lot of traction. I mean, one of the industry's most active acquirers with Keenan Advantage Group, they continue to make a lot of waves, dry bulk, especially areas where there are not presently a lot of exposure to some of the disruptions in our space. I think you're going to see that there. But on the opposite side, where there's tremendous disruption, particularly in drayage, I think you're going to see a lot of folks making big moves, because I think this has been particularly unforgiving for those folks. And through that disruption, I think that we could see some really interesting partnerships formulate during this period that changed the competitive landscape forever.
One Dre to rule them all.
Maybe so. Maybe so.
I like it. No, I like that take, because I've talked to a few drayage carriers, and even the train folks were getting excited about technology because it's so backwards, trying to go on the ramps, trying to get the rail heads from the drayage to the warehouse. Like, there's this whole like Kafka-esque process of just poor visibility and craziness that they're getting really excited about. Like, they're happy enough to figure out like using AI to read the barcodes on the sides of the containers.
Well, I think it's generally those industry pockets that are ripest for consolidation. So I think that we'll see a good bit of that. It's already highly fragmented. I think that the challenge will be trying to consolidate those cost effectively, because it costs the same to acquire a $5 million drayage company as it does $100 million. So I think that just to kind of package those together in a way that's efficient for the investor will be key to the ultimate success.
Well, Spencer, we really do appreciate your time. We're running low on time on our end, but if folks want to learn more about the Tenney Group, get in touch, see what y'all are working on. I definitely want to see that upcoming paper when you guys release in the coming weeks. Give us more info if folks want to learn more.
Yeah, I would definitely visit thetennygroup.com, but also follow us. We're releasing a ton of new educational series, multi-part, across all things M&A. Just follow me on LinkedIn. That's the surest way. Just Spencer Tenney on the LinkedIn profile or the Tenney Group page. And that's the best way to get updates on our deals, which we've got several coming up over the next month, along with all of our free content.
Perfect. Spencer, really do appreciate your time. We're definitely going to have to catch up again soon.
Sounds good, Thomas.
That's going to be a wrap for this episode. If you're just joining us, though, you can find us on Apple, Spotify, and YouTube, wherever you can download your podcasts. While you're at it, subscribe to the Loaded and Rolling newsletter. It goes out every Thursdays at 2 p.m. Eastern. That's a wrap for this episode. Definitely check out the good folks at the Tenney Group. A lot of stuff coming in the pipeline. That's it for this episode, though. I will see you all next week. Stay classy and stay tuned.